Now that we know what makes a trading strategy good and what makes a trading strategy bad, let's talk about how we can test a trading strategy to make that determination. It's with a process called backtesting. A backtest is simply a historical replay of how a set of trading rules performed during a specific period in the past. Backtesting is extremely powerful because it gives us insight on how good these trading strategies actually are. At a high level, a trading strategy might sound good, it might sound logical, and it might sound reasonable, but a backtest tells you how that trading strategy actually performed. Without a backtest, you don't really know if you have a good or bad trading strategy. It is one of the most important parts of the testing and evaluation phases. Now, when it comes to backtests, people have this flawed misconception that it's a perfect simulation on what's definitely going to happen in the future, and this couldn't be further from the case. Like I said in the beginning of this module, stock market returns are non-stationary. They change over time. So what makes a backtest good now might not be a good backtest in the future. Or put differently, a trading strategy that's good this year might be terrible next year. A trading strategy might be extremely good when the market is overall bullish. It might significantly outperform the broader market in every single way. But then the next year, some economic uncertainty happens and the market is in a bear market. That same trading strategy might be catastrophic. It might lose 70 or 80% of its value, while the broader market, the S&P 500, only lost 10 to 20%. So when you're creating a trading strategy and when you're backtesting it, you want to make sure that the strategy is robust, that it's not fragile, and it doesn't fall apart in different market conditions. Finally, when you create a trading strategy, you have to be aware that it's a historical simulation which is inherently biased. You might create a trading strategy using AI stocks with the highest revenue, and you see Nvidia, Google, and Microsoft are all on that list, and then conclude that you should always have a trading strategy that trades these AI stocks. But your perception is biased because you already knew that would happen. You already knew that these AI stocks blew up, so that's why you wanted to build an AI trading strategy. But next year, it might not be AI. Next year, it might be nuclear energy or green energy or bank stocks. It can be any number of things that change just because the overall market conditions change. You need to be aware that a backtest is biased.